All right, Manishi Raychaudhuri joins us. Let's say hello and good morning to him. And he joins us from what? Hong Kong this time?
Hong Kong, yes, Nikunj.
Tariffs have been
Pleasure to be
slapped
here.
on China. Tariffs have been slapped on China. 35%, at 20% of historical tariff, that makes it 55. On India, 26%. On Vietnam, 40%. And when such tariffs are slapped, financial markets should get into in panic mode, but that is not happening. It's a good morning for Asia this morning. Markets have recovered from the day's low. Are markets getting complacent or it's time to move on?
I think to some extent, the possibility of demand retrenchment across the world, but particularly in the United States, that situation has not yet been factored in. So I think the initial reaction of the market, um, despite this, what I call a nuclear trade, uh, almost a nuclear battle in a sense, in the trade regime. Despite this, the market's reaction has been calm, and honestly, it's a bit of a surprise to me. I think one of the reasons is that, okay, the markets are beginning to understand that 2025 is not 2018. Some of the large exporters to the United States are far less leveraged on the US this time around. China's proportion of exports has come down from about 20 to 25 to less than 15. There are other markets like Korea and Taiwan, which are far more leveraged to the United States. But there again, let's say semiconductors, they have been exempted from these reciprocal tariffs because they have other tariffs imposed on them under the Section 232. So there's this complex dynamics, complex web of reciprocal tariffs that have been imposed. The market will take some time to, kind of understand the full implication of this. But the broad impact would obviously be much higher inflation and much lower growth in the United States, which would obviously be driven by consumer demand retrenchment. And to that, most of Asia is still geared. I mean, United States is, about 30% of the world economy, a huge consumer market. So I don't think, Asia would be able to escape that effect.
Well, certainly. Hi, Manish. Manishi, good morning. This is Shrishti also joining in. Good to be speaking with you. But Indian markets back home, Manishi, are seen to be climbing that wall of worry. At one side, it's the IT pack that is once again seen to be a bit under pressure. But the pharma space is definitely in its pink of health. But help us understand that how do you analyze these sectors moving ahead, and where do you find sweet spots right now?
Right. So the topic du jour, the topic under consideration is, of course, the tariffs, right? And there, I think the IT pack, even though tariffs have not been imposed on the services, the IT pack is suffering more from the concerns about what would happen in the United States. Because US companies would obviously suffer from a wait and see mode as far as decision making is concerned. And that's got not good news as far as IT spending decisions go. You will see this almost certainly in the commentary that comes up during the upcoming result season from the IT majors. On the other hand, pharmaceuticals, let's take generics. Almost 50% of US import of generics come from India, and they really have no choice. And I think in this particular reciprocal tariff imposition, the pharmaceutical side have been left out of the consideration because of the same reason that I earlier talked about, because I think the Section 232 tariffs had been imposed on them earlier. So to some extent, I think it has come as some kind of a, some kind of a relief as far as India is concerned. India is somewhere in the middle of the pack. If you look at the headline tariffs, there are Southeast Asian countries that have been slapped with much larger quantum. So I think all this is kind of playing out, but we should not, sort of lull ourselves into a sense of security, a sense of safety, just going by what we are seeing today.
Manishi, but help us understand what is the long picture, if not today, then going ahead, what sort of a impact do you expect on the Indian markets in the medium term at least? Because we have been having and experiencing our fair bit of correction.
Right. So if you look at, let's say, this quarter or the next 2 months or so, I would expect the Indian market to correct. I mean, I actually recently published a report saying that brace for another leg down. And while these tariffs are a big sentiment dampener as far as the whole world is concerned, as far as India is concerned, I'm more worried about the result season and the consequent earnings downgrades, earnings estimate downgrade that most of the sectors are likely to suffer. You will see commentary coming out during the result season. I talked about IT, but you will see it from consumer discretionary, from industrials, from consumer staples, where that so-called recovery time point would continue to get postponed. And I think this likely earnings estimate downgrade is possibly the biggest catalyst as far as India is concerned. I would also think that the Indian rupee might depreciate after having appreciated quite sharply over the last 1 month or so. India would have to move away from cheap oil imports. It has already been happening from about 40%. Proportion of Russian oil imports is now down to about 30 to 35%. It'll likely accelerate. So all these things, when you put together, the short term looks cloudy for India. If you look at the longer term, I'm more positive. I would be more positive on the Indian markets, possibly in the second half of this year. I wouldn't talk about the usual long-term tailwinds that India has, but I think not only the valuations would be cheaper, but also some of the tailwinds in terms of government spending on infrastructure and even some of the consumption-related tailwinds, as a consequence of more cash being put into the hands of the public. Those things would possibly catch up in the third or the fourth quarter, and the market will take cognizance of that maybe in the second half. So that's in a nutshell. I mean, in the short term, I would expect a correction. I would be more positive on the Indian market in the second half.
Right, expected to be a bit more positive in the second half. Let's watch out for that. But Manishi, the other debate that is going on right now is that for, yes, India, it's a 26% reciprocal tariff being announced, but our neighbor, China, there has been 54% effective tariff with like 20% that was already in play, and then reciprocal tariffs might also come into play. And India is expected to be a beneficiary of the China plus one that is already going on. We have been debating for a fact, but help us, give us a sense that how do you analyze this situation? Do you also believe that India could be a possible beneficiary with China taking a backseat, or rather having more impact versus India?
I think what you would see going forward is some kind of a realignment among the entire non-US universe. You will see bilateral and multilateral trade agreements within the Asian bloc, maybe, the India-China trade agreements, which have, kind of long been postponed, long been on a back burner. They would actually, possibly improve going forward the trade relationships. Now, the supply chains would obviously realign. To some extent, I would think that, yes, I mean, the point that you make of some of the supply chains shifting to India, to maybe some of the other countries, not so much to Vietnam, because that's been slapped with a much higher tariff now. But maybe to parts of Southeast Asia and India, which has already started, would continue. But, what I think would be the bigger dynamic going forward would be much stronger relationships and, discussions, both bilateral and multilateral, between the EU and India, between pockets of the Western world and Asia, and within the Asian universe itself.
Before we let you go, give us some sense that how do you see FII positioning for the Indian markets? Because the last month there was a bit of an excitement, and we were also debating that maybe given the valuation correction and the valuation reset rather, maybe it's time that FIIs are still considering Indian markets. But now that the announcements are at play, we are looking for the earnings fine print. We have the RBI monetary policy. What is FIIs penciling right now for Indian markets?
So FIIs on an average are underweight India right now. I mean, if you look at India's weight in the emerging market, MSCI emerging market universe, it's about 18 to 19%. I think for an average FII, they don't have more than 15 to 16% of India in their portfolio. And some FIIs have far less. So those heady days, which we used to see, go back to 2020, 2021, when India was a consensus positive trade for the FIIs. That is not the case anymore. And so to that extent, there is headroom for the FIIs to increase their position in India significantly. Now, having said this, I think a couple of concerns, particularly the ones I talked about in terms of continued earnings estimate downgrades and potentially instability of the Indian rupee, those things might hold them back from investing in India in the near term. I think most FIIs, why FIIs only, even domestic institutions, would also watch for continued turmoil on the trade side. We have only seen the salvo fired by the United States. We haven't seen what the other countries are going to do, the retaliatory counter punches that are likely to come now. So you will see choppy markets for the foreseeable time horizon, and there could be a move to safe haven assets in the near term.
All right, Manishi, my last question to you was exactly on the same, that yes, equity markets are undergoing their fair bit of volatility, but on the flip side, it's a one-way rally upward for gold. Give us some sense that in the near term, do you believe the gold to be the safe haven and the rally to continue, or now that this announcement is done, it could be in for a bit of a pause?
Now, I've been talking about gold for a while. I think, possibly sometime in January when I was in your studio, I had talked about increasing allocation to gold. But, given the way gold has moved up, logically, I would be cautious about, allocating more assets, allocating more money to that particular asset class. Some segments of bullion, maybe silver, or, they haven't moved up to the same extent as gold has. So there could be some opportunities there. But having said this, when you have the kind of turmoil that we are seeing today in the risk assets, the immediate reaction on the part of asset allocators is to move towards safe haven assets. And gold ranks pretty high up in terms of those assets. So I wouldn't be surprised if gold remains steady or even moves up slightly more in the near term.
All right, Manishi, we'll watch out for that. But we let you go on that note. Really appreciate you taking the time out and speaking with us this morning.
If you like this video, then like, share and subscribe to ET Now.